So, welcome to my channel, and let me tell you something that is very important. It is very important for you to understand the fact that not everything is predictable. What do I mean by that? And this is important for you to understand because you need to realize that there are several factors that you don't see. That's why it is called a black swan, right? So, as far as the market is concerned, what you need to worry about mostly is what you don't see. That's how you lose a lot of money, right? So, what is it that we're not seeing? Well, if I'm telling you, then you're seeing it, right? So, that's not a good thing. What you need to realize right now is that there are several forces at play. The first one that is not really helping is the fact that the market is high. You know, the P ratio, if you believe in that measure, is pretty high. Okay. And by pretty high, I'm usually mean that, and I'm gonna show you what I'm talking about by high. And that is always something that you need to worry about, obviously, because you don't want to get caught by it. But let's first of all see the status of where the market is in terms of valuation per se. And then we'll see if we could identify something that we should be worried. At least you need to realize that it's happening, right? So what you want to see advertisement or whatever that is. Okay. So right now we have been higher. We have been higher. So look, we're here at 29. Have we been higher before? Before 2020, 2001 level when the whole thing collapsed. And definitely not at 2000 level when we were very high. Uh, but 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 we're getting there, right? So not a good place to be as far as valuation is concerned. But I will tell you that you know don't worry too much about things that you're going to control. I mean, when we talk about the P ratio being high, that means that we are paying, I think in this case is like 37 times earnings per share. For every dollars of earning, you're willing to spend $37. For Tesla, you're willing to spend $67, right? It's a lot of money, right? But what you need to realize is the fact that as earnings are going to be coming into the play, right? The PE, the price to earnings, the earnings are going to go up. So the P ratio is going to drop. Well, obviously, what's going to happen? They're going to say, well, if earnings are going up, then I'm going to bid up the price. Then they're going to bid up the price, and the P is going to go back up again. But that's okay because what it is, you're getting more earnings, right? So that's why everybody's focusing right now. Everyone is focusing on the earnings, on the earnings season, and it's saying, okay, we bid up these prices, we paid a lot for it, right? But is it making money? So that we could justify such high multiples. Because, like I said, if the price is here and the earnings is here, right? And we've been bidding up the prices and the whole thing, the P has been going up. What they're saying is, can we see the earnings go up? And that's what we're seeing. So that's going to bring the P multiples down a little bit. So we're not going to be that um, that overvalued. Okay, so that's one thing. That's why no one is really focusing so much on the earning on the inflation and the recession. I wouldn't say it's all news, but I don't think we have a recession, an inflation problem. I think it's under control, and I don't think we have a recession on our hands. And don't forget, subscribe to this channel, like it. So I will send. I usually post every day my recommendation, my views on the market, which changes all the time. So what we're saying right now, we're talking market collapse. Is it going to collapse? Not now, not because of recession of inflation, What you need to worry about is what you're not seeing. And what is it that you're not seeing? And it's not the earnings. We've seen the earnings. It's not the P. We've seen the P. What you're not seeing or what you might not be aware of is the wall of refinancing. What? This guy talking about? Who cares? Hold on. Give me a second. Yeah, let me explain to you what you're not seeing. Remember, I mean, you may or may not know, but corporates, especially small companies, and by the way, if you're following GCT, it's up 6%. So I've been recommending this stock. It hurted me a lot since October 7th, but now it's giving me some love. And don't forget to join my Patreon channel so you could see my trades. Anyway, so what's going to happen is all these companies are going to refinance because corporates, the transaction are like 3 to 5 years. 3 to 5 years. And of course, as you refinance, you mean you're going back in the bond market or the loan market, you say, hey, I need more money. The bank's saying, sure, I'll give you money. Sure, I give you money, but the interests are higher now, right? You refinanced 5 years ago when rates were low, but since then we've hiked we've come down a lot, but we're still higher. So therefore, the cost of refinancing is going to be expensive. It's going to take money away from you. It's going to be more expensive. It's like you buy a house, it's more expensive to buy a house. So that may take away. Now, the point is, how significant is this amount? How much of a big deal is it? Well, you know what? Let's ask our dear friend ChatGPT first, and then we'll go to S&P, right? And what is ChatGPT? How much corporate debt refinancing is coming due in 2025? Right? So let's ask it again so you could see. I get a kick out of it when it does its thing. In 2025, approximately 5 trillion of US corporate debt is set to mature, which includes both invest and speculative grade. Of the total, about 5 represents speculative. This represents significant refinancing challenge for corporation in light of higher interest rate and tightening financial conditions. The overall financing also is substantial of other region. So this is the wall that's coming. This is the wall that is coming to hit us. That is the whole wall that potentially could hurt us. Now, is it going to hurt us physically? It's not a real wall, so don't worry about it. But as you could see, maturity walls are pushing out of to 2028. Now, this is our dear friends S&P Global, right? And this is as of very recently, July. And they're saying, 60% of the $2.17 trillion are set to mature over the next 12 months. Even though maturities rise, borrowers are already making progress refinancing those maturities. By contrast, investment rose slightly. Okay. So here it is, right? This is what I mean when I say we have a wall coming up. You see that wall here? You see that wall, right? 2024, 2025, 2026, 2027. This is going to be tough, especially this one if we keep rates the way they are. Okay? So I got myself a wall. And the reason you need to worry about the wall is because they need more money to refinance, more money to pay, more money to refinance the debt. So that means they have less money available. So and the reason I would say this is not something that we're seeing because not many people are talking about it. Google it. Go on YouTube. Look, refinancing wall. I'm not talking about the real estate. I'm talking about corporates. That's going to hurt. I mean, eventually, that's what I said originally when I said that, when you have rates tend to, move up, but you don't see the impact right away. It takes a while. Like those rates that we're seeing decrease by, you're not going to see that the 25 basis point or 50 basis point decrease right away. It takes 10 quarters. This stuff is taking time. You have to be able to see where you are in the process. The point is you have the maturity wall coming up. The VIX. What's going on with the VIX? The VIX is what we call the fear factor. And it's basically a way for you to figure out what's going on based on the level of activities in the options market. I don't understand what he's talking about. Don't worry about it. All it means is that the higher the number, the more fear there is in the market. Let's take a look. Let's take a look at what the VIX looks like today. Right? Let me give you a date that you might remember. Remember that August 5th? Remember that date, right? August 5th? We had a problem August 5th. This is when we had the whole situation happening with um, the Japan situation with the carry trade, right? So we had a problem here, and that's where the VIC went up. Since then, everything has been hunky dory. But recently, as you could see with this line here, right, that's going as high as 22, and that was October 7th. Since October 7th, it has tightened a little bit. The fear is going down, but it is still higher than when we dropped to 14. So, do you need to worry about this? Well, what this tells you, it tells you that the dealers are worried, and basically they're putting lots of protection. It's a great market, but we're worried. It's a great market, but we're worried. It's a great market, but I'm worried about inflation. It's a great market, but I'm worried about recession. Okay, I'm not worried about recession. I'm not worried. Now I want to see how the earnings are coming. So let's see what's going to happen with the earnings. And then most importantly, we have the election coming up. Right. So with this election coming up, that's going to be a problem or not. Although right now it would seem to appear the market seems to favor Trump. We shall see. The point being is this: there is an increase in the fear factor, not by a lot, but it's so. Are they seeing something we don't? And like everything else in this market, you need to make sure that you understand what's really going on. Understand where you are in the process. You need to understand what your money is doing. You need to understand what is going on. And unfortunately, if you wait to see for them to tell you, it is too late. So what do you do? Well, this is a reason. This is a reason why the discussion that a video that I put up with Taleb Nassim is interesting. It's important. It's important because he basically tells you that I'm not going to predict the market. I'm telling you the same thing, by the way. I want to protect against it. I want to make money from it. I want to take advantage of it. How do you do that? Well, you don't try to figure out what's going on. Don't try to figure out whether or not we have a recession, whether or not we have inflation. These are just made up numbers, meaning that you really don't know what's going on the ground. But what you do know is that they're worried about something, then that will have an impact in the market. So you need to know what they're worried about. You need to know the mood of the market. For example, recently with Tesla, I made kind of mistake because I say, "Oh, look, the robo taxi is coming. So, let's get some calls in there because it's going to be great." I mean, the event itself was great. I mean, you saw a drive car with nothing and no wheels. I mean, no, no, no steering wheel, and you saw the van and people were clapping. I said, wow. And then, yeah, but you know what? He didn't provide enough information, and they were late. He's always not saying exactly when it's going to happen, why, and the stock took a dump, and it hasn't recovered yet, right? So that's the problem, right? What is it that you need to know? What is it that how do you make money in this market if you don't know what's going to happen ahead of time? So what you do is you protect yourself. Don't try to make money as much as try to protect yourself. You should have some hedges. You should have some long dated puts just in case. That's how all these guys made money in the hedge fund market. That's how Spitznagel made 4,000% at the COVID time because he hedged himself ahead, right? I mean, all you need sometimes is the option, the price to move like 0.5%, and the option will move 10%, 12%, depending how long dated it is, right? But you're not hedging to. This is not the hedging to make to for day trading or swing trading. It's hedging for a 20% market drop. To that end, I picked up on this interesting conversation. This guy seems to be pretty conservative. I mean, I don't agree with everything that he says, but I tend to believe, I tend to listen to what he says. He makes sense. He makes lots. So let us take a look. Let us take a look at what he has to offer, and I think you should listen to him. Why? Because you'll see. Okay, so here we're basically saying that you went up a lot. That's a lot. Well, I mean, yeah, but lots of good things have happened as well. Well, is the market is overpriced, which is this thing that I was telling you about the P/E ratio, right? Well, yes. I mean, that's the concern. The concern is obviously that if Trump or Harris win, if they win, they're gonna want to spend some money for you to help you out, right? So when you spend money, that's inflationary because there's lots of money in the system, and we did that already. Remember in COVID times, so that's gonna increase inflation all over again, which is not a good thing because that means they're gonna have to raise rates on you. So the idea, what these guys basically saying is that prices are too high, the stock market is too high. I don't like AI, and frankly, we're going to be spending more money, so inflation is going to come back again. I don't know what's going to happen. I just don't like it. I think the market is too high. I don't know. Yeah, you could get out and then you miss a boat, right? I could have sold when GCI went from 27 to almost 23. Now it's back up to 26. Come on, you know. Worry about things you don't know. Okay. So thanks for listening. Be wary. Something is out there. We don't know what it is yet, but it's coming. It may come soon. It may not come soon enough, but at least be aware of all, and I will bring them to you. And don't forget to subscribe. I will bring up anytime there's something that I think is going to impact the market, I'll bring it out to you. So at least you know inflation, recession, the refinancing wall, the VIX, and all these good stuff. You can take that to the bank.